For a long time, financial markets were shaped by a dominant narrative in which equities captured most of the attention, inflation dictated the direction of policy, and central banks maintained a restrictive stance to bring it under control, leaving sovereign bonds in a more passive role within portfolios. That balance is now shifting. As inflation has become more contained, though not fully resolved, and as interest rates have started to decline from their peak levels, European sovereign bonds have returned to the center of the macro financial landscape, not simply as instruments of income, but as key indicators of how markets interpret the broader economic environment. At the core of this shift stands the German Bund, which continues to function as the primary benchmark in the euro area, consolidating expectations around inflation, growth, future interest rates, and perceived risk into a single reference point, so that when it moves, it is not just a bond being repriced, but the market recalibrating its macro view. At the same time, the European yield curve has entered a phase of continuous repricing, shaped by a policy framework in which the European Central Bank operates without rigid forward guidance and instead responds to incoming data on a meeting-by-meeting basis, meaning that each release, whether inflation, wages, or activity, feeds directly into expectations and rapidly alters the pricing of duration. This has fundamentally changed market behavior, as investors are no longer approaching bonds purely as a static allocation, but are increasingly using duration as a way to express specific macro views, positioning for declining yields, maintaining defensive exposure, or adjusting tactically as conditions evolve. And in this environment, duration is no longer passive, but strategic, and access becomes part of the equation.